And good afternoon to you. It's Dennis Hudson at orangequant.com. It's Saturday, the 1st of May, May 1st, 2010. And today I don't really have a forecast for you. This is just a random thought about what you would do if you were a banker. And I want you to just kind of listen to this idea here and see what you think of it. Meanwhile, while we're waiting for that logo to go away, let me throw you a couple useful links. The first of these we'll be using in this broadcast is finviz.com. And Finviz, you just have to go there and see. It's an amazing site, and there's a heat map there, and the heat map will show up later in this broadcast. The other place is pincherplays.com, and that's run over there by Mav 5x5 and an old buddy of mine. And you can learn about Pincher Plays there, and I like to give him a plug whenever I can because he's got a very useful toolkit. So go and check him out sometime. Go there and then you click on forums and you can go in and see what it's about. Now, as quants will do, sometimes we just sit around and ask ourselves, what if? And that was what I was doing last night and today, asking myself, what if these banks, well, first let me set this up a little bit. As we all know, last year, April 2nd, the banks were allowed a brand new accounting procedure that allows them to basically mark to model instead of mark to market. I've talked about this before. It sucks, but that's what they're allowed to do. They are allowed to pretend that their losses, the losses on their books, are really assets. So they don't have to write them down because they're illiquid, supposedly, and therefore the argument goes, well, you shouldn't have to take the write down just because you can't sell it for anything. Someday it will be worth something. Okay, enough said about that. So my thinking is that some genius inside one of these banks, may not be one of these banks that you're looking at here. It could be a smaller regional bank or a real estate investment trust. It could be any number of investment type banks, but somebody who has an overhang of bad paper on their books is going to figure out that the first bank to fess up wins. In other words, the first bank to crash wins. And here I'm going to take us over to finviz.com and show you what a heat map looks like. This is Friday's action. And you can see who the biggest losers and winners were. And when you hover over a particular symbol, you can't see this part, but up in the upper right of the page, it shows you who it is and how much they gained or lost that day, what the price is, okay? And the way to do this is to go to finviz.com and then you click on the bigger heat map and it will expand and give you something like this. And then you can hover over stuff and see what's going on. So down over here, you've got all kinds of little banks. You've got insurance companies. Those are candidates for what I'm talking about as well. And just all kinds of financials, property and casualty, regionals, credit service type banks, and so on. So all right, what I'm illustrating here with this kind of a chart is not price, but let's assume that these banks that we're looking at here are at 100% of what the market believes right now is fair value, which is kind of ludicrous, but I mean, that's just for the sake of argument. And my premise is, what if one of these banks decided, hey, we aren't going to go with this mark to model stuff anymore. We're going to tell the public that we are now marking to market and we're taking the hit. And let's suppose, just for example, let's suppose that it's Key Corp, Key Bank, okay? And I pick on them for a reason because their stock price closed Friday, I think about $9, $9.02. And I feel that the bank that's going to do this first is going to be one of the ones that's with a lower stock price, okay? They'll also have, whoever does this is going to have reasonably strong internal fundamentals. They'll have some cash reserve. and their debt overhang might not be their bad paper might not be as extensive as some of these others. And Key Corp right now is running at about 4.1% of non-performing loans. I think that's in the real estate area. So, they're a likely suspect. I don't know that they would have that much to write down or not. But here's the scenario. They up and announce one day, ladies and gentlemen, we are taking a write down on $50 million worth of bad paper that we're holding. Immediately, Key Corp stock would drop probably 50, maybe even 60%. Who knows? A move like that on the part of a company that size would affect the other banks as well. They would drop maybe a full 20% on the day and start to float back up. Meanwhile, what the troublemaker would be doing is advertising to the public, and they wouldn't have to advertise too much, because if they did it, they'd get media coverage like you wouldn't believe. They'll be saying to the public, hey, we are now a clean bank. We have written down the stuff that you suspected we had to write down all along. Come to us. And money will start flowing into that bank, and their stock price will bounce and come back up. Now, last November, Key Corp was down around $5 or $6 anyway. So it's not that hard to fall. That's why I say you pick one, you start watching the ones with the lower prices, because the others really can't afford to do it. They can't afford a 50% hit. Key Corp could afford it and withstand it. They'd get a credit downgrade. They'd have to start paying more on their CDs to their depositors. But overall, they could come back, and by the time the lawsuits got cranked up, their stock would have risen back to at least 100%, that level where it was to begin with, and probably more, because, they've got public confidence now. In fact, I would argue that they would pretty soon overtake these other banks, and in percent terms, and go way back up above them. Now, why would a bank do this, other than this kind of gain that we're talking about? Because if they wait, all these banks are standing there waiting, and they know that sooner or later they got to write this stuff down. But if they, by standing around waiting, they're all going to slowly sink together, and that's coming very soon. So one clever player pulls a move like I've described. That's my theory. So what do? Well, I wouldn't recommend trying to play it on the day that it happens, unless you're very skilled, or unless you run with a gang of very clever thieves trying to play the bounce on that. I would wait for the dust to settle, wait for it to start back up, and then jump on for a nice long ride. But you got to look at the news, you got to look at why the stock tanked like that, and just keep it on your alerts, have email alerts set up. You got to look at all these factors so that you know what you're dealing with. That's what I would do. And just a quick disclosure that's really not needed, I suppose, but as I went through this whole thing, I did look at Key Corp's chart, and I am salivating to short it this coming week. I think. That's not a forecast. I haven't done the analysis yet, a FLIR analysis or synthetics or H205, but that is what's on my mind. So, what else did I do this week? Oh yeah, I shorted Morgan Stanley, and I didn't get what I wanted. I was in with puts. I made about 13 or 14%. And late the week before, I had jumped into some USG puts and got out this week with about a 40% gain. And by the way, as some of you know, I am now in with real money. I am actually trading. So those are my gains so far. So would you do this stuff if you were a banker? I mean, what would you think about doing this? Just wondered. Go ahead and post your comments. And I'm